This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
I listen to all of Jason's podcasts, most of them. I think I've got about 2 or 3 of them on my smartphone. But I have learned so much from him, and it has led to a lot of other different things, from health and fitness and just life in general. It's really amazing what he does, and I love it when he goes off on tangents. And Jason's insight's been really helpful too.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1742. So, as we are in this absolutely tightly squeezed, crazy housing shortage that everybody's been talking about, including yours truly, one of my newsletters had this little interesting tidbit that I thought was something I should share with you. So here it is. The Chipotle of home building, instead of BYOB, now what does that mean? Bring your own beer, bring your own booze, bring your own builder. Well, instead of BYOB, Lennar and KB Homes will help you build your own home. Since millions of Americans ditched city living for pandemic-friendly suburbia. Did I not predict that? I predicted that. I predicted it before anybody. Yes, I did. I want credit. Actually, I want you to get the credit because you're making money off of these great predictions. So keep on listening because there's more to come. Okay, so they ditched the cities for pandemic-friendly suburbia. Remember, back in 2012, I predicted the rise of suburbia. That was due to the autonomous car, but then I predicted it again not last February, but a year ago February, before anybody else. I predicted the suburbia mass migration, and hey, it happened like clockwork. Demand is still sky high with housing inventory sitting at 40-year lows. Wowza. Housing inventory sitting at 40-year lows. That's incredible. You know, there used to be a show called That's Incredible, and that is incredible. Wow. Can you believe it? Housing inventory is the lowest it's been in 4 decades. Now, segment that for the entry-level housing, and it's got to be substantially worse, of course. Who knows what the number is, but it's substantially worse. Because the inventory in the middle and higher price ranges has actually been increasing a bit. It's kind of some nice relief. Hopefully we'll actually see that in the lower price ranges, but I have no data to support that whatsoever. I think we're going to continue to see shortages for quite a while. But anyway, the little snippet says, we'll see if homes are still booming when Lennar and KB Home, 2 of America's largest home builders, drop earnings this week. So, you know, the developers looking at the home builder stock indices, right? And there's an indice that puts them all together. I can't remember what it's called off the top of my head. So anyway, it's out there. It exists. We've talked about it on the show before. But yeah, you know, maybe that's what we need. Maybe this is snarky. I don't know. But maybe we need kit homes. You know, Sears used to sell them. You used to be able to buy a home from the Sears catalog. Yes, you could do that. And it came with instructions, and it came with markings on each piece to show you how to put it together, just like an erector set. Hey, do any of you kids remember erector sets? Yes, they had them. That was pretty cool. Teach kids to learn how to build things with their hands. It was good. In our Empowered Investor Inner Circle, which, if you're not a member, you should join right away, empoweredinvestor.com. So, yeah. Kevin, thank you for posting this because it was great. It was funny, but, sad at the same time. Kevin posted in there and said, Cocoa would have been paying a lot more if it was $19.99 again. And this is the Producer Price Index. Kevin shared a chart in the Empowered Investor Inner Circle. Producer Price Index by industry. Dog and cat food manufacturing. And I thought this was great, this chart of dog and cat food manufacturing and a price index, and it shows the recessions, and this is available on the Fred website. So just kind of interesting when you look at inflation. And I did a couple of interviews. Well, I did 3 interviews today on other people's podcasts, and we usually play most of these. We don't get them all up there, but we play the vast majority of them on the Jason Hartman In the Hot Seat podcast, which is a podcast we run where I replay interviews where people are interviewing me. So check that out if you're interested. Occasionally one of those makes it on this show. It's just kind of interesting. You get a different perspective when someone's interviewing versus speaking monologue, or I'm interviewing someone else. So in case you're interested in that, a lot of listeners have said that they like that perspective, and it is available to you. But in one of these interviews I was doing today, the host said, hey, this inflation-induced debt destruction thing, it sounds great. I agree with it, but share with us the downside risk. What could go wrong? What could possibly go wrong? Well, something can go wrong. Deflation. Deflation makes the debt a higher burden. And when the debt is a higher burden, the choice you have is to either suffer through it and bear the consequences, although I think it's highly unlikely given everything that is going on in the world and the fact that there is the war between, as I've explained before, between bad fiscal and monetary policy on one side, and on the other side, what do you have? You know what I'm going to say. You have technology. Technology being deflationary and bad fiscal and monetary policy being inflationary. Technology actually has its limits. Its limits of innovation, materials science, literally physics. Integrated chips are getting so small nowadays that they can't keep the electrons in their place. So we are actually hitting a wall as to what can be done with the chip technology. And of course, we all know we have a chip shortage as well that's causing an automobile shortage and a shortage of many other things. But that's another topic for another day. So anyway, Empowered Investor Inner Circle, go to empoweredinvestor.com and check that out. And you may have to refresh your browser because we changed it. It used to have the information about the Empowered Investor Live Conference, but that is over. So now we have the Inner Circle up there, so go check it out. And let's get to part 2 of our interview with Richard Veg today, as he talks about a whole plethora of interesting topics. So we're going to finish that up today, and let's go to it right now. It seems to be pretty solid. I mean, there's a couple of examples where maybe it's not, but they're a drop in the bucket, right?
Well, you're exactly right on both those counts. Real interest rates are very low. That's a huge factor in the market right now. And then, Dodd-Frank made it law that lenders had to see that whether there was the ability to repay on a mortgage loan. So that pretty much stopped all of that problematic underwriting behavior. And as you announced at the outset, I'm in the regulatory business at the moment, and I feel good about what's being done there.
Yeah, that's good to hear. Talk to us a little bit about your regulatory career. I mean, you're Secretary of Banking and Securities for the Commonwealth of Pennsylvania. Is that sort of like the SEC of Pennsylvania, the state agency that would be comparable to the SEC?
Not quite, but directionally, yes. We're in charge of examining state chartered banks and licensing a number of other financial institutions, including investment advisors and mortgage servicers and mortgage lenders and the like. So we have a lot of responsibility there. We work hand in glove with national federal regulators like the FDIC and the OCC and the Fed and others, and have a terrific relationship there. And, as you said, we've gone through one of the most stressful periods in American history. And I think the financial services industry has held up really, really well. I think that's in part because of a lot of positive things done at the federal level.
So it sounds like you're more on the banking side than the securities side, even though securities is in the title, right?
We have an equal dose of both.
Oh, okay. Right. Okay. Interesting. Good stuff. Good stuff. So pretty solid. I'm curious about FDIC insurance, and maybe you don't deal with the credit union side of it, but credit unions have a similar type of insurance, and I guess the limits are the same. Is that as secure as the FDIC, or maybe more or less so? Of course, if there was a huge crisis, the FDIC could never afford to pay out. We know that, but no one's lost any money so far, right?
Yeah, I feel very good about NCUA and the credit union's safety and soundness and the adequacy of that insurance. Credit unions are invaluable providers of financial services, and we're certainly very supportive of it.
Yeah. I was just always curious if that insurance is pretty much on par with the FDIC, or better or worse. I just never knew the answer to that question. So what are we headed for? Mainly maybe inflation-wise, because that's a huge issue for people's future and what it means for the price of everything and the value or devaluation of their savings, stocks, bonds, et cetera. What are your thoughts there?
Well, we've studied inflation pretty intently, and we've studied it since the inception of the country forward. So we've got, inflation data really back to the late 1700s. And the U.S., generally speaking, has not had a problem with inflation. For all the people that obsess about it, we generally have had fairly benign inflation. The exception has been post-war periods. So after the Civil War, after World War I, after World War II, we've had a 2 or 3 year period of pretty high inflation. And the reason has to do with the destruction of production capacity. So a lot of farms in Europe after World War II and World War III simply couldn't grow any food until they were kind of restored and replenished. So the US had to supply the world with those things. Prices of grains went up. That's very easily to understand. And those farms came back on stream, prices went down. My own personal view is the period we're in right now is very similar. We've had productive capacity of, whether they're meat purveyors or chip makers or you name it, that's been wiped out. People are still having a hard time.
I can't believe it. I don't know. How are we still in a shortage mode right now? The shortages should have ended 8 months ago.
Well, I think we've got a couple of years of this.
That's
my
amazing.
Own personal view.
Wow.
That it's going to take, a year or two for production to catch up to supply. And that could be disruptive if we have a few more variants that are problematic. But I would say it'd be fairly typical to think we got a couple of 3 years of inflation, and we'll be back after that. We'll be back to a disinflationary period.
Okay, so what you're saying, it sounds like, is that the inflation problem we're having now, and sounds like you predict we will have for a couple more years, is a supply-demand shock problem, not a monetary problem. So Milton Friedman, if he were here, he would, of course, argue, and he would say it's everywhere and always a monetary phenomenon, right?
Never was a statement made that is less true than that statement.
Tell us about that.
From late 70s, early 80s, when he made that statement, the money supply has outgrown GDP fairly dramatically. Debt has, in the 40-year period since then, debt has done nothing but go up in relationship to GDP. The money supply has done nothing but go up in relation to GDP dramatically, and interest rates have done nothing but collapse. So I think the opposite relationship exists.
Well, so why are you pointing out the interest rates? Are you just saying that that's the way inflation is priced into the future?
It's manifested. I could have made the other statement as well. We charted both. Interest rates and inflation go down in a somewhat rough parallel over that period. So inflation and interest rates have both gone down since, let's call it 1981 to the present, in the very period that there's been explosive government debt and monetary growth.
And I like how you mention comparing money supply to GDP. And economists do that a lot. Do you think it's appropriate to also compare money supply to population?
Oh, absolutely. Absolutely. Yeah.
Because
The best measure is
GDP, yeah, like I wonder how that looks on a chart if you took population size, GDP, and inflation rate. Now, of course, that's the official inflation rate. A lot of people argue with it, including myself, but whatever, we'll just use it because it's there. How would that look if you put how would it compare to population growth?
We look at that. It looks pretty similar. And I think that's the best measure. So measuring it in relationship to per capita GDP is probably the best, most rigorous measure.
Do you think the thing, Richard, that's allowed inflation to be relatively benign, even looking at the 70s, where we had maybe 13% official inflation in one of those years, or the early 80s possibly, I can't remember. It's nothing compared to Hungary, Zimbabwe, Weimar Germany, anything in history, or Argentina, or even more modern examples. Do you think it's technology that's really tamped that down? Has that been the barrier to high inflation?
Certainly technology and other things that have enhanced productivity have been helpful. But I would tell you that if you're comparing to Zimbabwe or Poland or one of those folks, they actually did print a lot of actual currency and put it into the economy. And we don't do that. We issue more debt, but debt has maturity and an interest rate associated with it, and has an accountability regime associated with it. And these folks were printing actual currency. And this is also true in the Weimar Republic. That might have been equal to 50 or 75 or 100% of GDP for several years in a row. So it would be the equivalent in the United States of our GDP is 20 trillion. If we printed, 10 or 15 trillion dollars in actual bills, for several years in a row, we'd have the same outcome. And of course, we haven't ever done anything even remotely close to that. So to me, it's a different phenomenon.
I've heard a lot, this has been sort of quoted around, and you sort of don't know exactly what the nuance of these statements are or how accurate they are at all. But 20 to 35% of all dollars ever created were created last year during the pandemic, right? You've probably heard that or seen that out there. Is that not a concern very much? And then take us through why the money creation being the form of debt is different than the actual currency units. I like how you talked about maturity dates and so forth, but what does that really mean? How does that play out, and why is that not so inflationary?
Let's think about the debt markets in the United States for a second. There's about $35 trillion worth of private sector debt, and about 20 to $25 trillion worth of public sector debt. So that's about 60 trillion. And that doesn't even include, you'd add a couple more trillion for states and local governments. And if you want to throw unfunded pension liability, you're talking 65 or 70 trillion dollars worth of debt in the US market, if you're being honest about it. So for the Fed to create $2 or $3 trillion in a short period of time, while we feel it, and it's a big deal, I don't want to minimize it at all, I think of it in relationship to 60 or 70 trillion. I don't think of it in relationships to the Fed's prior balance sheet of whatever it was, 4 trillion.
Yeah, okay. All right, so that was one. So really what you're saying is in the overall scheme of things, even though it seems like a lot,
manageable number.
Yeah, okay. All right.
And when we look at history, if you just, anybody can do this at home. You don't have to be an economist to do this. These are easily accessible numbers. If you look at the creation of more government debt, or if you look at the increase in the money supply, or if you look at the Fed's balance sheet, so those are three kind of overlapping things, but they're their own things. And you look at that through time, the relationship between inflation and interest rates and the growth in those, if you look at the actual data, has been inverse. So my own view is, forget the next 2 or 3 years and the COVID disruption of supply. generally speaking, more debt brings lower interest rates and higher inequality. And it brings inflation of not of the CPI, but inflation of asset prices.
I was going to ask you to differentiate consumer prices versus asset prices, and that does create more wealth inequality. But please go ahead. Yeah,
it creates more wealth inequality, which is to say, it creates for the holders of real estate, it's a good thing, and for the folks that aren't holders of real estate, they get left further behind.
Yep. But how does more debt create lower interest rates, though?
Well, I can tell you what any number of economists, including Adam Smith himself, have said about that. I'm rereading Wealth of Nations right now, and it's a very painful process, I must tell you. But what the early folks just said is, the more of something you have, the less it costs.
Well, that's interesting. Yeah.
Debt is always a two-sided transaction. Money is created by debt. Debt is created by money.
Mm-hmm.
You know, when you lend money, you create deposits. So you have to think about both sides of the individual balance sheets and the aggregate national balance sheet. The more debt you have, the more money you have.
Mm-hmm.
The more debt you have, the more wealth you have.
Right.
It's not the way people are used to thinking.
Sure.
But I tell you, in early America, they were sitting there and they had interest rates of like 6 or 7%. And in England, the interest rates were 3 or 4%. And they automatically said that's because their debt market is larger and more well supplied.
Yeah.
And as ours gets larger, we'll have lower interest rates.
That's an interesting point. And so it just basically says that the further we expand what people are very critical of, which is this fiat money system, right? The further we expand it, actually kind of the better it gets.
Well, the better it gets for some, and I think the
the more unequal it gets. Yeah, true.
I think one of the biggest problems in American society right now is the exacerbation of inequality. That's one we're going to be wrestling with for a while, and this is part of that equation.
And that's hollowing out the middle class, which is a very sad thing. Yeah, it really is.
And becomes a societally problematic thing as well.
Couldn't agree more. I totally agree. Good stuff. Well, what else would you like to share as we wrap it up? Richard, I could talk to you for 3-4 hours easily. Just anything I didn't ask you, anything you want to point out about your books or your predictions.
Well, I think you've asked all the right questions. I would just say two things. The first thing I'd like to say is, if you're interested in American history, get the book, An Illustrated Business History of the United States. It's designed to be a fun book. It's designed to be an enjoyable book. You don't have to take Advil when you read it. So that's one thing I would say. And the second thing I would say is, you've got a terrific show. You're a real leader in this industry. And it's an absolute privilege to be on your show. Oh, well, thank you so much. That's really nice of you. Appreciate it. Good stuff. Well, Richard, do you have a website you want to share with people? Well, you can go to richardvague.com, RICHARDVAGUE.com. Excellent. richardvague.com. And thank you so much for joining us. We appreciate it. Thank you. So George Gammon, Jason Hartman, and we've created a high-level mastermind group called The Collective. The goal of The Collective is for you to learn from the three of us, as well as, of course, the other members, on how to build and, more importantly, how to maintain your wealth. In this video, we're going to go into detail about what The Collective is and what it can do for you. Enjoy. So I'm Ken McElroy. I've been in real estate for over 30 years. Started with a 2-bedroom, 2-bath using my own money, and now I own over $1 billion worth of real estate that I bought over the years, built a big company. We have a construction company, a development company, a property management company, and of course an investment company. And typically now we syndicate and work with large, both private and public institutions for the equity and the debt. And so what I bring to the collective is how to scale, how to grow, starting with one really small property with no experience at all and growing it into an organization, which I've been able to do that basically runs almost without me. So that's what I'm going to bring to the collective. We decided to start the collective because, one, I met George Gammon, and George brings a very interesting perspective about the economy and the Fed and the way money works and Bitcoin and alternative types of investments, which quite honestly,
I was super focused on real estate almost the entire time, and even I want to be a little bit more diverse. So when I talk to George and to Jason, they're always doing very, very different things on the investment side. Jason specifically is more focused on the single family housing and what's going on in that market so that we could collaborate and have different viewpoints on different things. And so that's why I thought the collective would be good, because I think everybody's kind of searching for the same kinds of answers. So the collective means to me basically the collective group, the whole. And I've always been a big believer of team and collaboration. So for me, it really means collaboration of everyone kind of coming into a room and learning from each other based on their individual highs and their individual lows, and to be very, very respectful of all their independent views on things, and to be more open-minded, transparent, and authentic. So I cannot wait for the group to get together each and every quarter, because we all have very different walks of life that we're going through. And so it's very, very cool to get into one room with like-minded people. I think the right person for the collective is somebody who's into personal development, somebody who's trying to be a better individual, somebody who's trying to have that work-life balance, trying to figure out good decision-making on the investment side specifically, good decision-making on the personal side perhaps, certainly on their health and on their wealth. The members that have already signed up are people typically that have businesses that they're growing, businesses that they've started, or businesses that they've sold. So typically they're higher net worth, and they're trying to figure out what to do with their money. They're probably a little bit afraid of inflation. They're probably a little bit concerned about where to invest. And they're obviously looking at real estate as one component, somebody that's trying to do the right things both on the personal side and on the financial side. So some of the experiences that members can expect to get out of the collective are certainly the network. And I think that's always super powerful. I've been involved in groups like this before, like EO and YPO, the Entrepreneurs Organization, and YPO, which is Young Presidents Organization, which is kind of a peer-to-peer network. And that's what I envisioned, and I think people are going to certainly get that out of there. They're going to have lifelong friends for sure from this, and they're going to meet people at every single event. But also, we're going to have fun. So as an example, things like race car driving and doing all kinds of really cool things and meeting celebrities and things like that, and fashion shows are going to be part of it. So it's kind of how do we have fun and learn together, and we're going to have that at each and every event. So thanks for watching. If you guys are interested, there's a link below you can click on. It'll take you right to the website, which has a load of information on exactly what the collective is, where the next events are, and what exactly you'll be getting if you become a member. Thanks for watching.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.